Welcome to the deep dive video update. This is a video where we have to look deeper into some charts that really aren't speaking to us right now very loudly, but sometimes we can still get some clues by looking at these charts. Also, there are some other charts that are unique just to this video. This is being prepared from Monday, July 22nd. I do have a thing called the SPX investing program. It launched at the beginning of June. It's free for right now. I will be locking it down in August. If you want to learn more about that, please look in the description below this video. There's also a link to more videos that talk about the program that is offered. This video that you're seeing right now is just one of many. I do a lot of weekly videos, but the main foundation of my analysis and commentary is in the daily video. So if you find this video interesting, please feel free to check out the daily video. The first chart that we look at is a chart of the VIX, just to see what the current range is right now by plotting a 50-period exponential moving average. And even though we're going down right now over the last few sessions, the VIX overall has been declining into a lower range as the market has been more positive. Also, we look at the VIX and then we do a ratio of a thing called the VVIX, or the VIX of the VIX. And typically when this is going down, that tends to be more positive for the market. With the little weakness that we've seen over the past few days, this is starting to turn back up. So we'll be watching that to see if it actually turns the trend and goes higher. Also, we look at a ratio between stocks and bonds as far as volatility is concerned. We're starting to turn back up again as stocks have been more volatile than bonds, and that's when we see the VIX moving or outperforming the move ratio, where the move ratio measures the volatility of bonds. Even though we've been declining, we're still 14.24% above the previous all-time high set in early January 2022. Then there's a thing called technical alerts, and here's a whole page. And typically when you see a lot of blue or green, that's positive. When you see a lot of red, that's negative. And we were bouncing around, and a lot of real technical changes took place this past week. This is for the whole week right here. We start at the bottom and read all the way to the top. I go through these alerts in every daily video and sometimes discuss them a little more in depth. Also, stockcharts.com has this thing called technical scores, where you try to remove as much emotion from a chart as possible. And it's scored on a scale of 0 to 100. The higher the score, the better looking that particular chart. I look at 5 indexes. The S&P, which is the foundation for what I do. We also keep an eye on the Dow, the NASDAQ 100, the mid caps, and the small caps. And coming in first place for the first time in a long time are the small caps, as represented by the IWM. They've been looking pretty strong. It's what a lot of folks are talking about. We're wondering if this breakout is for real. Now, we really shot up earlier in the week, only to pull back quite a bit. We'll see if there's any kind of a continuation that can happen in the upcoming week. But right now, they're coming in first place at 92.6. And a score of 90 and above, that means that we're looking pretty solid from a technical perspective. In second place, way in second place, is the SPY, coming in at 79.9. It's been pulling back because it has a lot of the mega cap stocks and large cap stocks, which have been under pressure, but it's also a bigger index. So there's more value in other areas that were performing better throughout the week. And internally, the SPY is still holding up fairly well. In third place are the QQQs. That's been the leading index for most of 2024. This is where we're seeing some weakness right now as the mega caps and large caps are pulling back, and it's coming in with a score of 68.5. Then we have the mid caps, which were stronger earlier in the year. And there was a few times when I did this video when the mid caps were even in first place. Well, they're not there anymore. They're coming in with a score of 65. And then in last place, just coming off of setting a new all-time high, is the Dow with a score of 59.6. Then we look at some short-term charts. This is a short-term rainbow, although I try to extend it back a number of years. And even though we've been falling back and we're coming into the rainbow, we're not really seeing any of the lines rolling over, at least yet. If we're going to see more weakness from here, we'll see this continue to go down and eventually the lines start to roll over. We also look at a thing called the boom indicator, and I have this in the short-term section because the first area that's usually hit is how far away are we from the 20-period moving average. We had become quite far away from it, and now we're snapping back and actually moving down below it as we're seeing the short-term trend in the S&P turn over to negative. We were extreme when we measure the distance away from the 50-period moving average, but that's also been pulling back, and we're also coming down slightly when we measure how far we are away from the 200-day moving average. Then some intermediate term charts. Here's another rainbow going from 50 periods up to 100 periods as far as the moving averages. We're still going up because even though we've been declining, we're above all of the lines in the rainbow. So they're still going up, meaning that the intermediate term trend, at least for right now, is still positive. Now, if we see further weakness, if we fall below that or stay below the 20-day moving average, the next logical moving average would be the 50, and that's when we would come down and start to possibly challenge this rainbow. We are now starting to look at the 50-day moving average. Now, we're still above that, but in case we see more weakness, that will come into play. Still further out is the 100-period moving average, and we're quite a ways away from it, and this is still looking positive. This is more intermediate to somewhat long-term, but this trend is still intact for the time being. And we look at the anchored moving average, where regular moving averages count backwards, where an anchored moving average, you set it at some kind of previous high or low, and then it shoots forward. If we see follow through weakness, I'll probably start adding some anchored moving averages to these other significant lows to see if they provide support. Also, we measure the distance away from the 200-period simple moving average. We have been pulling back. We're still positive in the long term for right now, since we're green and we're above the 200-day moving average. But we just want to keep an eye on this just to see how the long-term trend is holding up. Then the measurements from the October 2023 low up to the all-time high, we have been pulling back, but we're still up 25.35% from the October lows. The CMB composite had been extreme positive for a number of days. Now it's dropping off and looking more negative. If we drop below this black line, that means we're looking more extreme negative, and I'll start showing this chart again in the videos, the daily videos. This Connor's RSI was extreme positive while we were really moving up. Since that time, we've fallen back. We're negative right now, but we're not necessarily extreme negative. And the mass index is not generating a signal. When we get up around the red dashed line and the blue line, that's when we pay more attention to this chart. Also, the Pring bottom fisher, which did generate kind of a nice little signal, even though we didn't bottom at that point. It was picking up some kind of a bottom. Well, we've since dropped below the red line here, and it's starting to turn back up. We'll have to see if we see more weakness and some kind of a base being filled or some kind of support that we're coming to, if we end up seeing a cross with this particular indicator. And the Bollinger Bands, we were getting outside of the upper Bollinger Bands as the S&P was really going up. Since that time, we've pulled back and we've dropped below the midpoint. And that's why you're seeing that we're dropping below the zero level here and actually turning somewhat negative. And we compare the S&P 500 on top and the S&P 100 down below. And the S&P 100 was really leading the S&P 500 higher because it has the mega caps and the really big companies in it. Well, it's now kind of leading the market lower as we're seeing some weakness in those areas. Ichimoku cloud, even though we have been coming down, we're still above the green cloud for right now. Then we do the full study, or on a price basis, we're starting to drop below the blue line, but the blue line is still above the red line. So that's still positive for the time being. We're also coming down and dropping below the red line. That's also somewhat negative. We're seeing the green line, after it had been going up, starting to pull back. So we'll be keeping an eye on this. This is more measuring of what is actually happening with the trend. And some long-term charts. We go from 50 periods up to 250 periods. Even though we've been falling back, we're still above all the lines in the rainbow. So the long-term trend is still positive. In the stocks in the S&P 500, and we look at a 10-day average of the highs minus the lows, We were showing some improvement, and we still are. This is a little bit longer term since it's a 10-day moving average. It hasn't come back up to this extreme positive reading yet, which typically shows good momentum, but we have been showing some improvement here. But takes a little bit longer for this indicator to adjust. And we look at a long-term trend measurement called the Special K daily chart. Even with the pullback that we've been seeing, we still are in a long-term positive trend according to this momentum oscillator. And we look at a weekly chart of the S&P and a weekly chart of the German DAX. That's the biggest stock market in the EU. And their correlation had been pretty strong. When we get high readings down below, that means that they're moving more in tandem with each other. Lately, it's been really dropping off. So we're not really getting a lot of insight with this relationship currently. And we look at support and resistance. Just in case we keep falling, I've readjusted this for the all-time high that was set recently with the S&P and the pullback that we see so far. If we continue to fall and really see more declines than what we've already been seeing, we'll be watching this 38.2% retracement level. Then some broad market measures. This is the Vixen, where the VIX measures the volatility of the S&P 500. The Vixen measures the volatility of the NASDAQ 100, and it's been going up as the NASDAQ 100 has been going down. And we look at a ratio from the Qs to the Dow, and this relationship's starting to get a little bit stronger now, but we're seeing this ratio really going down as the Qs have been underperforming, and the Dow has just recently set a new all-time high. Some rate of change charts, these go back 250 periods, seeing a little bit of weakness here on this chart and also coming down a little bit further below the blue line. We were a little bit concerned when we were getting close to this blue line. Sometimes that means that we've gone up pretty far and we're due for some kind of a pullback. And as of right now, it looks like that could be developing, but it isn't necessarily changing over to negative. Then we keep an eye on bonds. We look at TIPS, which are Treasury inflation protected securities, and we do a ratio with 3 to 7 year bonds. And I don't usually show this chart in the daily videos because we're not seeing really big moves in one direction or the other. What's concerning here is when this is going up, that means folks are worried about interest rates and inflation. And we want to see this going down, but this ratio is actually going back up, even though it's been chopping more or less sideways recently. So we'll keep an eye on this. We want this to go down to be more positive for the stock market. Then we look at the TLT, which is the long-term bond ETF, and compare it with the S&P 500. Their long-term correlation is still fairly strong. So bonds based on price and stocks based on price are moving more in the same direction at the same time. We're seeing that dropping off a little bit more in the short term. And then we look at the QQQs with the TLT, kind of the same thing here, where their long-term correlation is still fairly strong, even though it's been showing some weakness. Then we look at the US 10-year yield on top. We subtract the German 10-year yield on the bottom. Since US rates are higher, that's why we get an answer above zero. And then we look at the US dollar index in the middle area. And because of the interplay between interest rates and currencies, this is showing that there's a fairly strong correlated relationship between the two. So if this is going up or down, typically the US dollar is going up or down in the same direction at the same time. We're keeping an eye on the yield curve. They're still inverted. We've been inverted with the 10 to the 2 year for over 2 years now. And we've been inverted with the 10 to the 3 month for, well, I think it'll be August when it comes up to actual 2 years that they've been inverted. I have some other yield curves here, but they're not as popular for looking at this inverted yield curve. What we're going to be watching for is at some point, if these go back to looking more normal, that quite often begins the countdown to see if we're going to go into a recession, which usually is about 5 to 6 months on average. Could be shorter than that, could end up being longer than that. And we don't even know. The market is still anticipating that we will not be going into a recession. Then I have some things called the possible positive scenarios. And this is when we're really screaming down and seeing some real hefty declines. Sometimes these charts can give us some clues that possibly we're bottoming out at that point. But these charts are still useful, and I use a lot of them in the daily videos. Some charts that I haven't been using is a 200-day moving average study of those stocks in the S&P that are above their 200-day moving average. And even though we've been seeing some weakness recently, we're still above 50 here. Now, we use this like an oscillator. When we get an extreme positive or negative reading, we're not seeing that right now, but we are above 50. So we are positive still with this chart. Then we take that same basic idea and measure the stocks in the S&P above their 50-day moving average. Also, there's another chart in the daily video that I go through this, but we use this one like an oscillator, not an extreme positive or negative reading. We've been declining as the S&P has been going down. And we've been keeping an eye on the mid caps. Also use this like an oscillator. They're still above 50, so we're looking positive there. And what's showing more strength are the small caps, where they really started to shoot up. Didn't get to an extreme positive reading, but we have been seeing some weakness over the last day or two with the small caps even. So thank you. I hope you found this helpful. Please feel free to check out the other videos that I post. Have a really good weekend, and I will talk to you in the next video.